How to trade options on Robinhood for beginners. Okay guys, so in this tutorial we're going to talk about trading options on the Robinhood platform. So Robinhood is basically, for you guys that aren't aware, Robinhood is a commission-free brokerage that launched several years ago, and basically you can buy options, cryptocurrency, and stocks for free without paying any commissions, guys. So if you don't already have a Robinhood account, just click the link in the description box below and sign up for an account, and you'll get a free stock when you open your account. So let's get right into it, guys. So for this example, the options, I'm going to be using Ford, and the reason why I'm using Ford is because most people know what Ford is. It's a cheaper stock. The stock is under $10, so a lot of these options are going to be much cheaper. And the good thing is when you're trading these cheaper stocks, you can get started with a little bit of money, guys. Even just $50, $100 is enough, and you can, if you know what you're doing and you listen to some of the tips that I give you in this video, and also do your own research as well. There's lots of other great YouTube videos out here. There's even some books you can pick up. You can start to learn this as well. So let's get right into it, guys. All you have to do is head over to Robinhood. For this example, I'm going to be on the desktop, but if you have Robin on your phone, you can follow along, and you just open up the app and head over to Ford, and then there's a button here. So on the desktop, you just click Trade F Options. So F, the ticker symbol for Ford stock, and then it's going to go over here. It's going to show the options chain. So what is the options chain? Well, the options chain, as you can see, it's loading right now. It is basically all of the strike prices along with expiration dates for the calls and puts. So now we have to basically go through each one, and I'm going to explain what a call is. So a call is the right but not the obligation to buy a stock at a certain price with a certain expiration. And a put is the right to sell but not an obligation of a certain stock, a certain put. So the most basic strategy that you'll see is basically you want to buy calls and buy puts. You can also sell calls and sell puts, but that's a little bit more advanced strategy. I think the easiest way to get started on Robinhood is to just simply buy and then resell those options for a profit. So let's just start. Since we kind of explained what both calls and puts are, let's start with calls. So, this market is a very bullish market right now. The S&P 500 is at an all-time high, as you're watching this video. And basically, when you're in a bull market, calls are going to be your best bet. Why? Because stocks are soaring, right? So you want to buy puts when you think the market's crashing. So if there's bad news, if there's things like the pandemic or something like that that's going to hurt corporate earnings, any negative news will send markets down because of fear, so you want to buy puts. But when markets are optimistic, you want to buy calls. So let's go through each one really quickly. So here we have the strike price. So the strike price is basically the price of that particular call option. So that is basically the right that you wanted to buy, because remember, a call option is the right to buy but not the obligation. So the reason why they say it's a strike price is because if you were to exercise these options before the expiration date or on the expiration date, you would be able to purchase the shares at $8. And this is one of the reasons why people use call options in general, or just options period. It gives you a lot of leverage. So for example, as you can see here, Ford stock is currently at $8.50, and I'm looking at a call option expiring about a week from when I'm recording this video. But there's also different expiration dates, so you've got obviously weeks ahead, months, and even years. So these yearly ones are called long-term call options. But for right now, I'm going to talk about the shorter term ones because those are the cheaper ones. So let's say I'm pretty sure that Ford stock is going to close above $8 before November 20th. Well, then what this does is by buying this option, it's 58 cents. If I were to buy one contract represents 100 shares. So that's a round lot. So what this means is that if I were to exercise this contract, it would allow me to buy 100 shares of Ford stock at $8. So this price here is called the option premium. So it's like insurance, right? When you get an insurance premium, like let's say you get insurance on your house or something like that, you're paying a little bit of money in case something goes wrong with your house. But, you're hoping that there won't be any problems with your house or something like that. That's why the insurance company just charges you a small premium. Well, it's the same thing with stock options. You're hoping to sell these options for a profit. So you're not going to, whereas if you wanted to basically trade, let's say 100 shares of Ford stock, you would have to spend $850. but you can control 100 shares of Ford stock for only $58. So it just allows you to control a larger amount of shares for a much smaller price. And this is why options is so powerful, because you can control a ton of shares at a huge discount. So let's say we wanted to kind of up our game a bit, right? Let's say we really wanted to control 1,000 shares, right? Well, to control 1,000 shares of Ford stock, if you just wanted to have 1,000 shares, you'd have to put up $8,500. You know, not everyone has $8,500 to invest in just one stock. I know a lot of people do, but if you're just getting started or something like that, you have a lot less money. That's not realistic. But if you use options, instead of spending $8,500, you can just buy 10 options contracts and you only have to put up $580, and you still control 1,000 shares. So let's say before this expiration date, let's say Ford stock goes up to $9. So what this means is that your option will be in the money $1. So then the options contract is usually going to be worth its intrinsic value. So how would we calculate the intrinsic value? Well, we would simply say, okay, let's say the stock's at $9 and I bought the options contract at $8. So that's a difference of $1. And if I had 100 shares, then this options contract would be worth about $100. So generally, you know, obviously there's some volatility and the price is going to be worth more or less depending on how far it is in expiration. Usually the more time it's further in expiration, the more the premium is going to be. But that's kind of a general rule that if Ford stock were to go to like, let's say Ford stock would go to $9, that this contract would go from 58 cents to like $1.05, something like that, depending on what the bid or ask is. But now you can see how powerful this is, because you can basically almost double your money if the stock just moves up like 50 cents. Whereas to actually double your money, if you were to buy 100 shares of Ford stock, the stock would have to go from $8.50 all the way to $17. So that's really how powerful calls are. And then now on the flip side, that's the same with puts. So the same with puts is that when you think a stock is going to go down in price. So it's basically the exact same thing, it's just the opposite direction. So let's do a quick example here of a. Okay, so on the other hand, the same thing works for put options. So you would buy a put option if you think the price of Ford stock is going to go down. So as you can see here, all of these put options, by buying a put option, it gives you the right to basically sell 100 shares per contract of an option. So as you can see here, you see a share at $8.50 and the strike price is $8. This option is traded at 5 cents. So for 100 shares, one contract would be about $50. So let's say that the price of Ford stock were to fall. So let's say Ford stock went from like $8.50. Let's say it went to $7.50. So let's say the price of the stock dropped about $1. Well, then this option would have an intrinsic value of about 50 cents per share, because you bought the put at $8 and then the stock went to $7.50. So you paid 5 cents a contract, and then now these contracts would be worth, give or take, around 50 cents. So you basically 10x your money. So this is how powerful options are, guys. Really straightforward. You want to buy a call if you think the stock is going to go up. You want to buy a put if you think the stock is going down. So I'm going to give you guys a real life example on this Robinhood account of how I did a simple trade using Electromechanica, ticker symbol SOLO. How I traded SOLO. I just put up like $50 and I was able to turn $50 into $200+ with a very simple trade, because as of recording, when I'm making this video, as right now, electric car stocks are red hot and I knew this stock was going to move, but I didn't want to put too much money up because I still have a lot of money in my long positions, and I don't trade long on Robinhood. I like to just basically trade options and things like that. But I'm going to show you guys this example. Okay, so here we are in my example right now. So we have Electromechanica. This is an electric car stock based out of Canada. They're rolling out their one-seater solo vehicle in the end of 2020 and moving on to 2021. So all of these electric car stocks have been super hot towards the end really basically after the pandemic in March, most of these stocks have went like crazy, but especially in the second half of 2020, electric car stocks, probably some of the hottest stocks in the entire market because renewable energy is just red hot right now. So what I did is I simply bought a simple contract. So I bought a $4 call, right, with an expiration of 11/20. I bought it for 50 cents. Okay, bought it for 50 cents. I bought it on November 13th. I just bought one contract, guys. So I just put up 50 bucks. That's it. Using options, remember now, each contract is worth 100 shares. So I just put up, instead of buying the stock at whatever it was trading at the market price, I believe the stock was at like closer to $5 when I made this trade. I just put up $50 to control 100 shares. Now, I already own a long position in Solo in my Fidelity account, but I wanted to own it long, but I wanted to make some quick money on the options as well. So what I did was I bought it, right? Then I simply held the stock overnight, and then I was able to sell that option for a profit of around $220. So I'll show you guys exactly what I did, the strategy I used on this chain. Okay, so we take a look at the options chain. So pretty simple, guys. As you can see here are the expiration dates. Now for this strategy, I didn't want to risk a lot of money. Depending on which expiration date you use, it'll change the price of the premium. So the more into the future it is, the higher the premium. So if you guys are super bullish on like an electric car stock or something like that, you could also buy some super duper long-term calls, and you can hold those calls for a long time. And that's probably another strategy I'm going to talk about in a further video, but this video is more sort of kind of profiting from short-term price movements. So as you can see here, that option that I had bought and sold I sold it for $270. The price dropped. So the reason why the price dropped is because the underlying stock, it went up high, and then the underlying stock dropped as well. So guys, remember the option is tied to the stock price. So what I like to do is, I don't like to be too greedy when I'm trading options. Obviously, I want to make as much money as possible, but I'm not trying to time the highest price to sell. So as you can see here, if you look at the stock when I sold it, it went all the way up to around 745, and then I sold the option right when the stock price kind of dropped to around 670 or so. Now I probably should have sold it over 7, but I don't know. I thought it might rebound, but it didn't really rebound. It kind of just trickled and just kind of fanned out. So what I try to do is I try to make sure I'm at least doubling or tripling my money. And if I see the price coming down, I just get out of the trade. Remember now, it's not about buying it at the very lowest and selling at the peak. You want to get like the meat of the trade, right? So you're not going to squeeze out if you're trying to squeeze out every little penny, you're going to struggle with options because they move so fast. And then if it's coming down and you're hoping it's going to rebound and you're holding and holding and holding, it's best to, buy it low. Once it goes up, get your money, get out of the trade. Remember now, this is not a long position. You can always rebuy the option later at a cheaper price. And that's exactly what I did in this example, guys. So I hope this video was helpful, give you guys a quick rundown on trading options for beginners. I'll leave you guys with a couple of more tips about trading options in general and some things to look out for. So the first thing is make sure that the underlying stock itself, if you're going to buy call options, or if you think it's going up, you're going to buy put options, make sure that you would actually buy the underlying stock if you're buying call options. Because one of the mistakes I make is sometimes I'm trying to buy a call option in a stock that I see is going up, but I wouldn't necessarily own the actual stock itself. And I think that's a bad move because now you're being emotional. You're just buying the option because you see the stock price going up. But if you actually would own the stock yourself, then the reason why the stock is going up is for other reasons, intrinsic reasons. The business is doing well. They've got deliveries, revenues increasing. There was a good news report. There's been legislative changes, something like that. So try to make sure that before you buy the option, you would actually own the underlying stock. The second rule I would have is be sure to cut losses. So some of the mistakes I've made with trading options is simply holding on to the contract too long. I try to never lose more than 50% in an options contract. So I have a kind of a risk reward ratio of lose 50% to double my money. And I never put too much in any one options trade. As you can see with the example I showed you guys, I only put up $50. It's not like a long position. Options, they just move so fast. And remember, it's going to expire. So as you get closer and closer to the expiration date, the option is going to be worth less and less and less. So make sure you put up more than like 10% of your total capital. Don't take your whole Robinhood account and just go all in. Because if you're wrong and the option goes down a lot, you can wipe out your entire account. So use some risk management. Don't put in more money than you can use. And if you have a substantial account, don't put in more than 10%. Probably 5% is better, right? So let's say you have $1,000 in your Robinhood account. You can start trading $100 an option. You don't need, one of the mistakes I made in the past is like, I have $1,000 and I want to trade 500. You know, the options, they move so fast. You can lose $200, $300, $400 in like 10 minutes. So just be sure like you have some risk reward. You're not putting in too much money, and that way you won't wipe. Okay, now the third tip I'm going to give you about trading options, and this one is a really useful tip as well, and that's try to buy options near the money or in the money. So obviously I talked about making sure you would own the stock. You're buying a call option, not risking too much money. Try to get options in the money, near the money. So if you take a look at this Ford example, you could get this option for 58 cents, and the chances of, you know, Ford stock plummeting, it could plummet, but the option's in the money enough that if you resold it and you took a small loss, you're not going to lose a lot of money. Whereas if you buy the option like $10, it's just a complete gamble, and you only have until like 7 days for the option to be worth something. If Ford stock just hovers around $8.50, your option is going to expire worthless. So try to buy options near in the money. It's going to increase your success rate. In fact, if you're really conservative, buy deep in the money options. Because let's say the strike price is $8.50 and you buy it here at $6, you know, yeah, you're not going to nearly make as much money if you're buying these cheap ones, but the chances of Ford stock going from $8.50 to $6, like losing, you know, 25% of its value, more than 25% in 7 days, is unlikely. So I would say that would be another strategy. If you're super conservative, buy deep in the money options. My fourth tip is take a look at some of these longer term calls. And I really want to make a separate video on it, but I wanted to show you guys quickly. If you guys are super long term thinkers and you're looking for catalysts down the road, for instance, let's say, you know, Ford's making a lot of changes. They say that they're coming up with batteries, they're coming up with new SUVs. Let's say you wanted to buy a long term call option for like next June, right? So that option is going to be a lot more expensive because there's more time up until expiration. But this is a good idea if you think that there's a catalyst in the future. So as you can see here, this option is now it's $1.41. So let's say you think that there's a major catalyst in the future. You can buy in the money call options way into the future. That way, maybe Ford stock kind of hovers around $8.50, but you have some bullish event in the future. Or if you think, hey, Ford is definitely cheap, you can even buy these out of the money options, maybe for like $11 or $12. You only put up like $25 a contract, but you have about 6 months for the stock to go up. So that's another tip. If you're thinking of a certain catalyst in the future, buy those longer term call options. And the fifth and the last tip I'm going to give you guys is do not trade on emotions. Sometimes, you know, when I make an options trade and I'm making a little bit of money, I immediately want to, you know, cash in my chips and move on to the next trade. But I know that's a mistake, and it's simply a mistake because you don't want to trade on emotion. So usually when I have a good win, I usually close my trade and take the day off, right? I'm not looking to make trades. I'm only making trades and options when the opportunities come to me. And that's kind of something that I've learned the hard way. You know, either whether you're trading stock options on Robinhood or you're just trading long positions in general, you don't want to trade on emotion. If you're like on a losing streak, just take a break. You know, sit down, take a break, you know, go over your strategy, see where your weaknesses are, and see where you can improve. But don't trade on emotion, because that's the quickest way to completely wipe out your account. And then if you wipe out your account, you're out the game. So I hope this video was informative, guys. Those are kind of my tips and strategies on trading options on Robinhood for beginners, guys. I'm about to wrap this video up. I'm going to come out with some more advanced videos and give you guys some more advanced tips on some other strategies such as selling calls, selling puts, and even things like spreads, condors, and stuff like that. But that's going to be a future video. Those are kind of some more advanced tips. But right now I would say, you know, put in like 5-10% of your capital, find some stocks that you would actually own, right? Buy a couple call options if you feel confident about those positions. Give yourselves at least a week in advance. Try to get them near the money, and see how you do. You know, obviously, You know, one of the best times to trade options is during earnings season because stocks move very sharp on earnings. So that's definitely a good time to trade options as well. I should have probably talked a little bit more about that, but earnings is definitely a very popular time for options traders. But really, when stocks are moving in a certain direction, there can be many catalysts. There can be earnings, of course. There can be, legislative changes. It can be, for example, I'm according to this video, a lot of stocks have soared ever since Biden won the U.S. presidency. So look out for key events. Find the stocks that you would actually own and buy those call options. And the same happens for put options. If you can find those key events and you think there's going to be a bad earnings release, or you're aware of a company losing a contract, or maybe a key member is leaving the board, or any other negative news, that can be a good time to buy put options as well, because most likely the stock price will crash. A good example of that would probably be the whole scandal with Nikola Motors. If you guys saw how Nikola Motor, let me just pull that stock up as an example of a way that you could have made a lot of money trading put options, because with Nikola Motor, you know, the whole Trevor Milton scandal and how the company had a bigger, market cap than GM, but it hadn't even produced a vehicle. So sometimes when you see stocks that soar way too high on too much hype, that's a great target for put options, not call options, but a put option, because you're like, okay, this stock is completely overvalued. And it's similar to shorting the shares, right? So a lot of people short stocks, but you can make the same profits by trading put. Okay, so my example with Nikola Motor, as you can see here, the stock was up to like $71, and then for people that realize, hey, how is this company, worth more than GM, and it doesn't even have one single car delivered, you could have bought put option, a lot of money, as the stock continues to crash. And it probably will crash much further because this is definitely a sketchy company. So that's it now, guys. I hope you enjoyed this video, my tutorial on how to trade options on Robinhood for beginners. Be sure to leave any of your comments, concerns, questions in the comment section. I'll do my best to answer each and every comment, because for some of you guys, I really know you're interested in trading options, and it seems to be the new thing on Robinhood. A lot of people want to make money with options, and you can do it, but you just gotta learn a couple basic strategies, set up a system, and try to trade without emotions, and you should do just fine. So that's it until now, guys. And please smash that red subscribe button if you enjoyed this content, and you'll get basically notifications. Hit the notification bell so you receive the notifications when I upload new videos. I'm going to be uploading lots of videos on options trading, particularly through Robinhood in the future, but you can use this strategy really on any platform. But I think Robinhood is excellent platform for trading options. Best of all, no commissions. So that's it until next time, guys. Take care.